New sanctions on Russia's oil exports are hitting prices for now. India's rupee hits a record low, Australian consumer confidence is holding up over summer, and business confidence improves again in New Zealand. That's coming up in our 5 Things in 5 Minutes. And then in today's bonus deep dive interview, ANZ Head of G3 Economics Brian Martin reviews why the market has swiftly pushed back US rate cut bets in the early weeks of 2025.
The market's just scaling back and saying that we're close to taking all bets off at the moment on rate cuts for this year until we see what the actual policy implementation is going to be like.
But first, in 5 and 5 with ANZ, global markets are broadly on hold this morning, awaiting key US inflation data tonight, with US stocks down around 0.3% and US Treasury yields down 1 or 2 basis points. Meanwhile, oil prices fell around 0.8% overnight, with West Texas Intermediate at $76.6 to the barrel. They retraced some of their 5% rise in the previous 4 days after the United States imposed new sanctions on Russian oil exporters. ANZ senior commodity strategist Daniel Hines says the sanctions will mostly have a short-term effect.
As we've seen in previous cases, the oil has continued to flow into international markets. This comes at a time when the Iranian issue is bubbling up. We've got Donald Trump entering the White House as well. So it'll certainly result in, I think, in a bit of volatility, a bit of disruption to trade initially. But ultimately, I think the amount of lost barrels, I suppose, to the market will be probably limited over the sort of medium to longer term.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was up another 0.5% to a fresh 2-year high. Most of that was linked to a rise against the euro. The Aussie dollar was flat at 61.79 US cents, and the Kiwi was up 0.1% at 55.92. Number 2. ANZ's Roy Morgan survey found Australian consumer confidence largely held on to its New Year gains last week. It fell 0.3 points, but it's still 3.2 points above where it was in December. ANZ economist Maddie Dunk says people often feel a bit chirpier over the holiday period.
What we've seen is that the biggest rise in confidence since the end of last year has been in how households are feeling about the outlook for their finances over the next 12 months. So that sub-index is up 7.8 points. Potentially, people are starting to factor in the increasing chance that there might be a rate cut coming soon. We at ANZ expect that the first rate cut will be in February this year, so not too long away for those people who are paying off a mortgage.
Number 3. New Zealand's economy appears to have come out the other side of last year's recession in the final quarter, as NZIER's quarterly survey of business opinion shows headline confidence increased. ANZ senior economist Miles Workman says for monetary policy, pricing intentions edged up, businesses reported that costs fell, and spare labour capacity increased.
The overall level of where pricing is currently sitting, that is consistent with about 2% inflation historically. So I don't think the Reserve Bank are going to look at that data and say, oh, we've got a re-accelerating inflation problem on our hands. I think they'll probably just tee that up to inflation stabilising around the 2% target, which is exactly what they want. It shouldn't represent any form of roadblock to them delivering another 50 basis point cut in February.
Number 4. India's currency hit a record low this week. That was above 86 rupee to the US dollar. ANZ chief economist for Southeast Asia and India, Sanjay Mathur, says the fall isn't due to external imbalances or a lack of foreign exchange reserves, but rather is being allowed to occur.
What really is a change now, or we anticipate a greater change, is the fact that the rupee was being very tightly managed by the central bank, and they are now starting to let it go, mainly because of a decline in competitiveness that has arisen from the depreciation of other currencies in the region. In terms of forecast, we think that the rupee will hit 88 by the end of March this year, and thereafter it would continue to depreciate, but at a much slower pace.
Number 5. Sanjay says while a weaker currency will push up imported energy costs, India's economy is in need of support for its export-focused manufacturers.
The rupee has become significantly uncompetitive. The real effective exchange rate of the rupee has risen quite sharply, and that is the primary reason why we need to see a weaker currency. As it is, we've seen 2 months of exports which were quite disappointing, and that's something that the authorities need to overcome. If they do not do that, one of the sort of longer-term goals of India has been to raise the share of manufacturing in GDP to about 25%. In reality, it has been stuck at 17%.
Sanjay Mathur there. Now, in today's deep dive interview, ANZ Head of G3 Economics Brian Martin talks about the strong start to 2025 for US bond yields and the US dollar, and retreating expectations for Fed rate cuts.
The market is worried about whether or not there will be any further progress on inflation, given that more restrictive immigration policy could push wages up and therefore inflation up, or tariffs could push prices up, not just in a one-off increase, but if they do disrupt supply chains, that could lead to more continuous price rises. So I think at this stage, the market's just scaling back and saying, look, we're close to taking all bets off at the moment on rate cuts for this year until we see what the actual policy implementation is going to be like and how the economy performs in the early stages of the next Trump administration.
So how significant was that December jobs report in terms of the positive surprise, and what does it tell us about the US economy?
It tells us the US economy is moving along really quite nicely. If you strip out the weak October labour market report where jobs rose 43,000 and they were pushed down really by the hurricanes, then for September, November and December, jobs growth in the United States has been growing at about 250,000 per month. So that tells you that the economy is still doing really well. It's indicative of GDP growth of around 3% of my calculations. So the market has therefore said to itself, if the economy is that strong, do we really need to see further interest rate cuts? So they're scaling back on that basis. However, I think if you take a broader perspective and you look at how many jobs were created in the United States in 2024, there was 2.23 million jobs. Now that is back in line, in fact, just slightly below the 2.4 million jobs that were created on average in the 5 years before the pandemic. So the labour market has normalised. And as we're seeing that normalisation underway, we're seeing wage growth come down. What we've got at the moment is a labour market that's still robust, but one that is not contributing to inflation. In fact, the latest inflation data, when you take account of strong productivity growth in the US of about 2.2% in the third quarter, that's actually consistent with a further gradual improvement in inflation towards the 2% target.
So we've got more US inflation data this week. What are the markets expecting?
The market's going for 0.3% on headline and 0.2% on core. We'd be broadly in line with that. Energy costs were higher during the month, and that's likely to push the headline number up. And in terms of core inflation, that's expected at 0.2%, which would leave the year-on-year rate unchanged at 3.3%. So that tells us that inflation has come down from the very high levels we saw, but that the incremental improvement at the moment is stalling. And that supports the FOMC's guidance, and indeed what has been our view for quite a number of months now, that the FOMC were going to move to a much more staggered process when assessing the appropriateness of lower interest rates for the economy. As far as what would be needed to reignite expectations of lower interest rates, I think you'd want to see core inflation coming in at 0.1%. And that would then say very soft PCE inflation in November. And if that was followed by a soft core CPI report for December, I think you could make a case that despite the economy being strong, there is still an underlying improvement in inflation taking place. In fact, that underlying improvement in inflation may be becoming re-established. So that's one thing I'd have to watch for there. What has driven the market to take out rate expectations for this year? I think in many ways it's a bit of a mirror image of what we saw at the beginning of 2024. This time last year, the market was gunning for rate cuts. In fact, there was expectations that the Fed would be cutting interest rates by up to 100 basis points by the middle of the year, and that indeed they could be cutting interest rates by up to 150 basis points in June, from some of the more extreme forecasts. This year, because of the change in administration that we're seeing at the moment, the market's taken out all its rate cut expectations. Now, what I would say is that pricing is very much driven on expectations. It's not driven by the data. And that tells me that there's a huge amount of uncertainty in the market pricing at the moment. In order to corroborate that expectation of no rate cuts, we're going to have to see, I think, to an extent, universal tariffs introduced in the United States. We're going to have to see a clampdown on immigration, and not just illegal immigration, but also immigration that would reduce the number of lawfully permitted residents in the United States or green cards in any 1 year. And that would upset the growth in the labour force significantly. And they're the things I'm really watching to corroborate current market expectations.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, January the 15th. Catch you tomorrow with a look ahead to Australia's December jobs market data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.